Welcome to this update on the personal service company regime. Many know this as the IR35 regime. Now, it's fair to say that many individuals form a company through which they operate, the so-called intermediary company or the personal service company. That intermediary company will invoice the end client for work done by the individual. The individual will then extract profit from their intermediary company by way of a salary, quite low salary, and dividend for the balance. More often than not, spouses will own shares, so that dividend is shared between spouses. Where the individual or his or her family control more than 5% of the company, then the personal service company regime has to be considered. Now, it's fair to say most of these structures, that more than 5% test will easily be met. But it can also extend to payments that could represent payment for services. So those structures that have been set up to get around this 5% rule are then caught by this little extra layer which extends to payments that could represent payment for services. That may well catch umbrella companies, for example. Now, the key to all this is if we ignore the intermediary company, is the individual's relationship with the end customer one of an employee or office holder? And if there is such a relationship, then the personal service company rules, the IR35 rules, can apply to those relevant engagements. Now, any income from those relevant engagements which is not paid out as salary is treated as a deemed salary. Now, these relevant engagements are when the tests are met, i.e. is it an employee relationship or a holder relationship in respect of that particular engagement. If it is, then it's a relevant engagement. And if that money is not effectively paid out as a salary, then it can be, after a few adjustments, a deemed salary. This deemed salary is deemed to be paid out as a salary to the individual on the 5th of April. As it's a deemed salary, POA and national insurance will be due. So effectively, the dividend gets reclassified as salary. Now, this does reduce the savings from low salary, high dividend, but the important thing to note on this is that very, very few companies are currently getting caught by IR35. Now, what we're going to do is look at how we calculate the deemed salary payment and then look at other things in this area. It is actually quite easy to get around, but we're initially going to look at, well, if we are caught, how do we calculate the deemed salary payment, and then a few other points coming out of that. Now, if we were caught by IR35, then the deemed salary payment is calculated as follows. You start off, and it's all done for a tax year, so you start off with the income from relevant engagements. That is the invoices that the company's raised on those engagements where the employee or holder relationship exists. You then deduct an automatic 5%. Now, that's effectively recognising that there are more costs involved in running a company, and that's what that 5% is supposed to cover, the extra costs of running a company. Now, once you've got the net, effectively, then you deduct some other costs. Now, you deduct expenses paid by the employer, which would be allowable as deductions from earnings if they were paid by the employee. So, for example, qualifying travel costs, subsistence costs, professional subscriptions, costs which would be deductible from employment-related earnings if the employee had paid them. You also deduct the employer pension contributions, the employer's NIC on the actual salary, and any Class 1A on benefits in kind. You also deduct the actual salary itself and the benefits paid, so car benefit, for example. Now, after deducting all those, you get this gross deemed payment. Now, when it says gross, it means including ERS NIC. So you need to strip the ERS out, which will be 13.8 over 113.8, and then we get down to the net deemed payment. Now, that is effectively the deemed gross salary. Well, let's pick up some key issues in this area. Now for starters, as I mentioned, it is only the income from relevant engagements which are included in this calculation. It could well be that some of the engagements you have got that relationship, employee, employer, and others you haven't. It is only the ones where you have that employee or holder relationship that are regarded as relevant engagements. The net deemed salary, i.e. the gross pay, is then subject to PAYE and primary national insurance. You effectively treat it as gross pay, and that gross pay is paid, or deemed to be paid, on the 5th of April. The PAYE and national insurance on that gross pay must then be paid over to HMRC no later than the 19th of April or 22nd of April if payment is made electronically. Now, as these deemed calculations can be a bit tricky or would take a bit of time, they may well not be done by the due date, then they can be provisional amounts, this PAYE and national insurance due, with any adjustments to those provisional amounts being reported via an earlier year update, which is submitted via RTI to HMRC before the following 31st of January. So it is effectively gross pay, but HMRC recognise because it's a deemed payment, then it's going to be trickier than just normal gross salary to sort out. So they give you this extension effectively. It's very important to recognise that the £2,000 employment allowance, that's that employer's national insurance holiday, is not available against the deemed salary secondary NIC. So you don't get the benefit of that £2,000 employment allowance. We've considered the PAYE implications, which the company would have to comply with, but let's now consider the corporation tax implications. The income received by the company will form part of their corporate profits. The gross deemed payment is deductible in arriving at the corporate profit. So that's the gross plus the ERS in respect of that deemed payment. The timing of the deduction is whichever accounting year the 5th of April falls in. So for example, if we had a 31 December 16 year end, then the deemed payment on the 5th of April 16 will be deductible in that accounting period. Now this does create timing differences, so many intermediary companies have adopted 5th of April year ends, just to make sure that in their year to 5th of April they get a full deduction for the deemed payment in the year to 5th of April. If dividends are paid, then there is a risk of double counting, because the individual is drawing out dividends, but the deemed salary calculations ignore that fact. And what you don't want to do is pay PAYE national insurance on the deemed salary and then also bring in the dividends to your self-assessment return. That'll be double counting. Now, when you have got this situation, the intermediary company needs to submit a claim to HMRC to set the deemed payments against the dividends paid. Now, this claim process is outlined in ITEPA 2003 section 58. Ideally, if you are caught by R35, you shouldn't be doing this. You should just be doing a monthly salary, because having to do these claims to offset dividends against deemed payments, then that is quite tricky. So if you are caught by R35, it is much easier just to pay yourself a salary, because ultimately that's what you're going to end up. So it's really when you've been caught by HMRC and you have taken out dividends and there's been this reclassification to deemed salary, that you'd have to think about this claim. When you effectively say that this deemed salary is to be set against those dividends. So what's new in this area? Well, the main change is that from 6th of April 16, there is a change to home to work commuting. Now, when you trade via an umbrella structure, employees will no longer be eligible to claim tax and national insurance relief for their travel and subsistence costs if they are subject to the supervision, direction or control of anyone in the supply chain. Now, this affects tax-free reimbursement of travel and subsistence costs for those individuals trading via an umbrella structure. These same rules, i.e. the travel restrictions, will affect limited company contractors but only when they are caught by IR35. If you are not caught by IR35, then all these 6th of April 16 changes to umbrella structures will not impact on your client. So the key there will be to make sure you're not caught by IR35, and we'll cover that in the next slide. Now, the other point to mention on this What's New slide is HMRC have been talking about reviewing IR35 generally, but as yet there's been no plans announced and no proposals had been suggested or leaked. So one can only assume that nothing is intended from the 6th of April 16. Maybe the new dividend rules makes changes to IR35 unnecessary. Maybe they've got something else up their sleeve from April 17. But at present, there is no changes from April 16 for the core IR35 rules. Well, finally, let's look at how we can avoid IR35. Now, it's fair to say that HMRC take very few IR35 cases. Most clients are fully aware of their exposure to IR35 and take steps to protect themselves from IR35. And it's very much trying to put in place contracts which really, not hint, I mean it's more than a hint, it's that they really emphasise that this is more like a self-employed relationship than an employed relationship. Now, when drafting those contracts, we've got to make sure you have key self-employed factors in there. The most important, by a long, long way, will be substitution. Now, I'll give you some example clauses, and this is clauses that I've seen in contracts come to me, and I lecture. And the people that I engage with, when they send me their bookings for 16, 17, etc., there generally is a clause on that booking form, that contract. And I'll just read you 3 of the ones that I've seen in the past few months. And they've been there for many, many years. So they just come out every year. Now, example clauses I've got on my contracts. The first one I've seen is, should the speaker be unable to present this session as agreed, they will find a suitable and equal replacement. Another clause, if you are unable to present this course, conference or webinar, you or your organisation is responsible for finding a replacement speaker and covering the additional cost this may incur. Another one, in the case of indisposition of the lecturer, then he or she or their firm will make every attempt to provide an alternative lecture of the same quality and standing as that of the contracted lecturer. And that is just the first 3 contracts that I've looked at. So it's a very, very common area. I don't believe I'm anywhere near IR35. But these clauses, they just emphasise the fact that my company is just definitely not anywhere near IR35 because there isn't this employed relationship or holder relationship. Now, it would help if some of these clauses were implemented. And in my own case, for example, in the back end of December 15, there was a fellow lecturer who unfortunately needed an operation, and I had to cover a few of his lectures. So it does happen, it will happen in a lot of areas, that for some reason you can't fulfill a contract and therefore you've got a replacement in, or vice versa. And that really makes HMRC's ability to apply IR35 to that corporate virtually impossible. So make sure we have this core self-employed relationship. If you've got that, then you're not going to be caught by the core IR35 rules. You're not going to be caught by the April 16 rules. Now, obviously, in some situations, it can't be avoided, and your client's not going to be in control of the contract. And it might well be that your client is caught by IR35, in which case you've got those deemed salary calculations in this lecture. But if you are caught, or you think you're caught, then it is better to just pay yourself a monthly salary. Given the dividend changes, it's not as bad at paying yourself salary as opposed to dividends. Dividends are still cheaper, but the differential is not as great as it once was. So if you are caught, or you think you're caught, salary is the way to go. Well, that concludes the updates on the personal service company regime. My name's Dean Wootten. Thank you for listening.